Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and I'm joined by the President of Wealth Management, Dale Colclasure, and co-founder, Mark Smalling. We've got a great show for you today. The title of this episode is Market Volatility and Your Retirement Date. Here's the reality. The markets only do one of two things. They go up, they go down. We have no control over when that's going to happen. So how do you remain prepared if the market were to take a sudden downturn right when you're planning to retire? That's what we're going to get into today. And Dale and Mark, I know this is an important conversation for us to have. How are you this week?
Having a great day.
Yeah, doing well.
Good.
Yeah, this is something we hear about a lot. Yeah, people are worried about it. Yeah.
For sure. Well, I want to start with you, Mark, because I know that this conversation was really inspired out of a recent conversation that you had with someone who came in to meet with you guys to receive that complimentary written income plan. And they had a retirement date in mind. That might be something you can relate to. So this person came in, they knew when they wanted to retire, but their biggest concern was, okay, what if the market takes a huge dip right when that day comes? So walk us through that scenario.
Yeah, we really see this. I mean, when you're in what we call the retirement red zone, it's that 5 years before and the 5 years after your retirement. But it's really, when people are planning, and they've seen their accounts sometimes at heights they've never seen them at before. And they're very concerned about if it drops, and if it drops, a lot of them think, "Gosh, I've got to work a little bit longer. I've got to get that back to that certain amount that they saw in their 401k or 403b plan." And then some people, and this one couple that was in recently, we work with a lot of employer groups that luckily still have pension plans. Mm-hmm. Pension plans can be affected, how much that pension benefit is going to be, or the lump sum, if that's something that's offered, can be affected by interest rates. Well, interest rate environment, the interest rates have started coming down again, which means that lump sums, benefits go up in these pension plan calculations. So we have a lot of people that towards the end of the year are having calculations done for 1 year and then the first of the next to see what might be most advantageous. And this one couple that was in, that's what we were looking at. So they're concerned about the pension. They're worried about the 401k on the side, whether or not we need to kind of just lock in those gains where they are so they can be ready to go, because they don't want it to dip below a certain amount, because that's what they already have in their mind. That's how they're heading into retirement.
Well, and I'm sure a lot of folks can relate to this. They've worked so hard and you've saved up this lump sum of money, right? Mm-hmm. And you're looking at that lump sum and you're like, okay, this is what I have to now last me throughout the rest of my life. I think this is why it can be really challenging for folks to think about withdrawing money and generating income for themselves, because they're going, well, yeah, now not only am I pulling money out, but if I'm pulling money out and the market goes down, that just compounds the loss and makes that money burn that much faster.
Well, they've always only looked at this retirement plan that they have as an accumulation asset. It's always, how do I get this as big as I can get? Because they've been in that accumulation phase.
Right.
The other huge thing that we know happens is the reality of since 2008, so literally in the last 17 years or 68 quarters, there have only been 5 negative quarters. Out of those 68. And the reality is if you're one of those people that you've been in the workforce, I've been accumulating, you probably only time you ever look at your 401k plan is when that quarterly statement comes out. Mm-hmm. Now, here's the difference. I know I'm getting 2 or 3 years or 5 years from retirement, and I start looking at it more often. Mm-hmm. And I begin to realize, oh my gosh, this thing changes every single day. It
fluctuates so much, right?
All I've ever noticed was that it went up. I mean, and I hear this all the time, but it's now we become more hyper-focused on what is that daily value and the daily changes, where the reality is, folks, they've been there the whole time. The difference is you've been in that accumulation phase. Dollar cost averaging has been your friend. The reality is when we're no longer adding to those accounts, we begin to have to draw out of them, dollar cost averaging or negative dollar cost averaging can actually work against me. And that's really the biggest issue, is it's not just a change in value. Because again, if we have a properly structured income plan in place, so what that means is, at least for this portion, without getting into too much detail, is I have a certain amount of my assets that are set aside that I know I'm going to draw income on for the next 1 to 3 to 5 years, depending on how conservative or aggressive someone is. that we have those really locked into very predictable outcome type structures to where I know I don't have to worry about the volatility of the assets I'm going to use. That way I have more peace of mind for the minor fluctuations that can occur in those more risk assets. I think the whole 60-40 conversation has been so oversimplified that nobody really understands what it means.
Meaning in your portfolio, 60% stocks, 40% bonds,
Yep.
and as you near retirement, that should shift, blah, 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 right?
Exactly.
It's a good way to summarize
I think it's so funny. We've had people come in all the time and says, oh, well, my 401k has done a pretty good job of managing my money. They're not managing your money, folks. You're in a target date fund. All they're doing is managing the allocation that's designed to get you to a 60% equity, 40% bond allocation when you turn 65 years old and you've set that as your date. There's no management in that. It's the reality of the markets are going to do what the markets are going to do. You need to have a plan in place that is customized to what you need your outcomes to be. And the other, because 2022 proved to us, and everybody remembers what happened when all of those assets move in conjunction and they all run negative for one particular year, that 60-40 portfolio is not going to protect you from losses.
I was going to say, a lot of people got a really rude wake-up call because they thought that they were invested more conservatively than they were. But then when stocks and bonds took a hit at the same time, they realized, shoot, I'm not as safe, quote unquote.
Well, the reality is that doesn't happen often, but it happens 15% of the time.
And it could happen right when you're planning to retire. That's why we're having this conversation,
well,
right?
Kristen, not just that, but the other reality is that if you're going to live the next 20 to 35 years in retirement, that's going to happen 5 more times.
Yeah.
5 more times.
Yep. And so you have to be prepared for it. You touched on this, but Mark, if you want to expand a little bit on understanding the stages that you're in, because again, so much of our industry, not just us as human beings working and saving, so much of financial services industry is focused on those accumulation years, but there's this important transition that needs to occur. So talk about some of the different phases that maybe folks aren't as aware of because they've not yet entered that phase.
They haven't, you've, as Del mentioned earlier, discussed the accumulation stage. Then we get into the decumulation, or we're starting to take income from that. So, and Del touched on this a little bit, that we're wanting to preserve some of those assets where we know we're not going to, suffer a loss on what we're receiving income from. So it's very important that we make sure, because if we don't, there's something called sequence of returns. And if we start taking money out of our accounts and the markets are down during that time, then we're a lot more likely to run out of money during our retirement than if we start off with years where the markets are actually going up, and that's when we start taking money out of the account. But there are ways to position yourselves and allocate your assets where no matter what the markets are doing, we can still protect and maintain and make sure that we're going to have income throughout our life. But it's really important to have a plan, which is what we talk about every week on the show, is having a written income plan and actually knowing where our assets are, what they're supposed to do for us, because there are different purposes for different asset classes and different investments that we have in our retirement income plan. And we need to have in multiple asset classes, not just one, because we don't put our eggs in one basket. So if we're not having these conversations, if you're not having these conversations with your financial advisor today, we encourage you to pick up the phone, scan the QR code. We'd love to talk to you about actually putting a written income plan together for you to make sure that you will not run out of money, during your retirement years.
So well said. I know we're going to get into some more specifics as we go on today's conversation about the right strategy for the right phase that you're in. That's what so much of this is about, right?
Yes, ma'am.
Well, Mark Dale, thank you so much. As Mark said it best, if you are already working with another financial professional and they're not having these kinds of conversations with you, you owe it to yourself to get a second opinion. And you can't get a second opinion from the same person who gave you the first. So we encourage you to reach out to the team of Retire Path Wealth today to schedule your very own complimentary written income plan. You can do so by calling 866-724-3893. Or if you'd rather connect online, simply scan that QR code and that will get you connected as well. We'll be back with more right after this.
I became a financial advisor through a referral from my financial advisor. I was leaving a career in the corporate world and basically was looking for something else to do. And he said, "Hey, don't you have a finance degree that maybe you can put to good use?" I went to college, was supposed to be a dentist. And physics and organic chemistry changed that path. I think it was the realization of having worked somewhere long enough to know that I didn't want to have to work for someone else, that I was looking for a more entrepreneurial career path. And the opportunity for financial planning offered that, to where I could basically have my own practice at that time. Started one of the biggest financial planning firms out there. There was a lot of positives learned from there, but also learned a lot of things that didn't really line up with my sense of belief, and knew that there were others out there that probably felt exactly the same way. So even though I learned a lot about the industry, I also began to learn that a lot of financial advisors are taught the industry by the vendors and wholesalers themselves, and came to the understanding that a lot of what we consider to be general consensus advice is really based on those techniques that are benefiting those that are teaching, not necessarily those that are investing in those products.
Welcome back to Arkansas Money Talk. I'm Kristen Oakley here with both Dale and Mark from Retire Path Wealth, and we are so glad that you're joining us today. If you're just tuning in, today's conversation is all about market volatility and your retirement date. How do you make sure that you are prepared so that no matter what the stock market may or may not be doing, right when you retire, you know that you're going to be okay and not be subjected to huge losses right out of the gate? Because you touched on this, there's something known as sequence of returns risk, which a lot of folks aren't prepared for. And that is that if you take large losses right at the beginning of your retirement, well, you may never recoup that, right? And that's what's so dangerous, because no longer is market volatility your friend like it was when you were younger and working.
No, that's absolutely correct. And and most people have no idea what sequence of returns risk is. They also don't know what kind of financial strategy they're actually employing in their retirement, because we have people that come in with their plans, and there's a lot of employer groups that we work with. So we're very familiar with the target date funds and what they're called. And so we start asking, and people just look at us with a blank look on their face, and they're like, I'm not sure. I don't know. Not until we look at their statement and actually show them, yes, this is what you're employing. And this is the target date strategy you're employing. And if you notice, it's getting you a little bit more conservative as you get older, and that's happening automatically. And that's what they think, somebody's managing their plan for them, but that's not really managing your plan. And no one's actually done any planning for you to determine what your risk tolerances are. Are you comfortable with the risk that you're currently taking? Mm-hmm. How does that fit with all of your other portfolio? If you're married, your spouse has a plan. How does it all work together? Because that's one big pool of money. It should all be working towards your common goal.
Yes, that's a really good point. It's more of that cookie cutter approach when folks have it in something like a target date fund. It's that set it and forget it, right? But there's just so many more complexities that come into the picture, and no two retirement plans that you put together for folks are alike, no two income plans, because no two situations are alike.
That's 100% correct, because everything's got to be customized, because everybody has different goals. Everybody has different outcomes. Everybody has different philosophical or emotional or whatever concerns that are there. And literally when 70% of the folks that are out there today are concerned about, their primary concern is run out of money, and that's fueled by market volatility concerns, which again are always going to be there. I mean, folks, and we assume that we're going to have some type of a correction in place, which means a 25% move in assets from top to bottom about once every 7 years. That these are not realities that are going to go away. But the idea of having a structured position to where you're drawing your income from, you have an understanding of how that portion of the portfolio works. The whole 60-40 allocation, I think, has just been oversimplified to be, dumbed down for lack of any other terminology, that people just really don't even understand what it's supposed to mean. And there are so many other asset classes, as Mark has referred to, that work for things. I mean, if you're someone who is more conservative by nature, there are investment vehicles out there that will guarantee a certain amount of income. I mean, so maybe a portion of my assets in a, quote, annuity, or that type of an option that's out there may make a lot of sense for a certain allocation percentage. There are so many people out there that have been so over-focused in growth investments. The Magnificent Seven, which, most people have no clue what it means, but they spit it out like they do every single day, literally have got a lot of those portfolios positioned in things that don't even create income. That's the other huge issue that we see coming in, especially from the big box stores, in the shop around the corner, is that literally is most of my investments have less than a 1.1% dividend return on an investment structure, which means the only way to create income is I have to sell assets because my assets don't create enough income to provide for my need. If we start with the end in mind, and the end is always income, folks, if I can build an investment structure that creates enough income that it produces on itself where I don't have to sell assets at an inopportune time where I'm able to make those decisions, we know that we have about a 70% more likelihood of achieving the goals that we're trying to accomplish because the portfolio is doing what it's supposed to do. As opposed to focusing on asset growth, we need to focus equivalently on asset income generation to where I'm making enough money to where I don't have to sell those assets.
As you were talking, I was reminded of what one of my mentors always taught me, which is it's in retirement, success is not about your lump sum. It's about your income,
yes,
right?
Ma'am.
It's about how are you going to generate that monthly paycheck.
It's all about cash flow.
Yeah, for sure. Well, I know we said every plan that you all build for folks is individualized. It's personalized and customized. Here on the show, we have to talk in a little more broad generalities.
Right.
So as someone is entering that retirement red zone, again, that 5 to 10 year window of time, both before they retire and after they stop working, what typically are the investment strategies that you're recommending? What are the types of things that folks need to tweak or adjust as they enter this crucial period of time?
Well, I mean, there's no doubt that as we're approaching and entering retirement, we need to have some dollars that are predictable, they're safe. And so we need to figure out, as Dale was talking about earlier, about, we've got to figure out how much we need in income. So we need to make sure that we can guarantee that income is going to be there, and then determine based on their own individual risk tolerances and their situation, because it does matter how much extra dollars you have above and beyond what you need to satisfy your needs, whether or not you can be a little more aggressive with that. We can't completely, in most situations, we're not going to completely leave the stock market investments because we need that to outpace inflation. Inflation is not going away. It's reared its ugly head again the last couple of years, and it's going to be there with you throughout retirement. So we need to make sure that we're outpacing inflation. So we've got to make sure that we have a portfolio that's balanced on both your goals and needs and also your risk tolerances. And that's the reason why it is so individualized, and it's not the same for everybody that walks through the door. Everyone that walks through our door we know is unique and their situation's unique. And that's how we're going to treat it, at Retire Path.
Well, not only that, Christian, everybody has a different source of already what we call mailbox paychecks. And so a lot of your investment structure is designed to simply supplement those mailbox paychecks.
So like Social Security, right?
If I have Social Security,
Yeah.
if I have a pension, if I've been a military and I have I have VA benefits, how all of those things fit into place. I think so many times it's always considered the other way around, is that let me turn on all these benefits and then I'll just take enough money off the top to fit that out. That doesn't fit for every single person. But the reality is that's what we see as the cookie cutter advice that comes, and people say, oh gosh, well, why did they tell me to turn all this stuff on in advance and then just supplement from here? Well, I don't know. Maybe it's because those are the assets they're getting paid on. They don't want to see those go away. But the reality is sometimes it may make sense to use some of those. We're getting back into a tax conversation again here. Oh, wow, folks, you notice how it always fits together in a complete plan? But the reality is that I've got to take all of these things into consideration first before I then come up with an investment strategy. My guess is that vast majority of folks out there, the only conversation you've had in this retirement situation is about the investment strategy. And the reality is if all you're doing is talking to an asset manager, it's the only conversation they're qualified to have. There's a very, very broad definition of what a financial advisor is. That's why, again, Mark and I are always going to focus on retirement income planner. If you're in this phase, Folks, you owe it to yourself to pick up the phone, to scan the QR code, to get in, get a written income plan process put together for yourself.
So well said. Dale, Mark, thank you so much. That number to call to schedule your complimentary written income plan is there for you on the bottom of your screen, 866-724-3893. Or again, if you'd rather connect online, simply scan that QR code and that will get you connected as well. We'll be back with more right after this.
We got to know where we're headed to. So I always call it a target that we're shooting for. The critical pieces of that is, at what age do you want to start looking at retirement becoming a reality? And then simply, what do we need for income to continue to live the standard of living that we're either accustomed to or that we want to have at that point? It looks like having a written income plan in place so that you know over the next 20 to 30 to 35, however long that time frame is that you have a sense of security of knowing that you're not going to run out of money. The idea is I like to be as tax efficient as possible, but we're going to be very proactive and futuristic, proactive tax planning. And then once we put that written income plan in place and they can look down to the end and there's still positive numbers left, at the end of that calculation, that's the most rewarding part of it, because you're going to retire once.
Well, welcome back to Arkansas Money Talk, where today Dale, Mark, and I have been having a very important conversation about market volatility and your retirement date. How do you prepare yourself? Because nothing is worse than right at the date and the point that you're planning to retire, the market takes a hit, and so does the income that you have worked so hard to build throughout the rest of your life that needs to last you for the rest of your life, yep. Right? So that's the challenge. And I think, market volatility, it's like a roller coaster. There's ups and there's downs. Right. When we're younger, I don't know, a lot of folks love roller coasters when they're younger. As we get older, maybe we're not into the crazy coaster as much. The same is true with market volatility. I know that some folks are tempted, we've all seen this in our right. career, that folks are often tempted to see when the market goes down to then pull all their money out of the market and go to cash. What do you say to someone who has that temptation?
Well, Kristen, I don't want to beat a dead horse here, okay? But here we've gone through this whole aspect that so many times the focus is on asset value, okay? That's the only thing I focus on. What we try to do is to show people that retirement success is all about the consistent generation of the income that you need to meet your current needs. The reality is that most people that are fearful of market volatility don't even need to be taking the risk that they're taking today. They don't know that though, because the only thing they've ever focused on is, gosh, the more risk I have, the more money I make. But it's not about making more money now, it's about generating cash flow at this point. And that so many times what I've always perceived of the need of a 7 or 8% rate of return, now they can accomplish with a 4 or 5 or 6% rate of return, which is much, much more predictable. But they don't know that until they've walked through a complete process, which is why we're always going to focus on the steps that we're going to go through. We're going to send in the data. You're going to meet with Mark and have an understanding of what we're trying to accomplish. Then we're going to build a plan. Then we're going to take that 30,000 foot view and then we're going to walk through the details that make the most amount of sense to you. So we're always going to walk through that process to find out what you need to accomplish before we put the investment structure in place. And many times people are pleased to know, I don't need to take all of the volatility risk. But then if I know that I have this huge gap because we're focusing on income, and if I need $5,000 a month and we're showing that they can produce 10, man, that means about half to 60% of my assets I can really be as risky as I want to with, because I'm never going to need those to generate the income I need to produce.
But I mean, the number of people that we actually see that come in, and you can look at their statements that have moved money to cash, to money markets. A lot of them did it in 2022. We saw a lot more, do it after 2008 and 2009, where they wholesale moved everything, into safer assets, money market, bonds and things, and never moved them back, and have suffered the lack of returns since there because of that. So we see that all the time, but you realize as we get older, we do have a tendency to become more conservative, because we will have people, as they're filling out their financial questionnaire, it's interesting to see that people will put that they're moderate or aggressive, and then when you get in there and talk to them, going, But I'm tilting more towards conservative the older I get or the closer towards retirement I get. That's not unusual. That's normal. And in some respects you should. Now there are some people that are going to be the pedal to the metal till the day they die. That's that's just going to that's it.
Yeah.
That's how they're wired. But they're usually married to someone who's absolutely the opposite of that.
Yes.
That's just how it works.
Yeah.
Well, and the reality that we already discussed is so many times I think folks who have not taken the time to educate themselves to exactly what risk means, and that's the nicest way I know to say that, is the reality is that their determination of, I'm pretty conservative is, as we mentioned, we've had 5 negative quarters out of the last 68. My accounts didn't lose money. So I must be moderate to conservative because they're not looking that on a daily basis, only on a random glance.
Well, and this makes a really strong case for a danger of leaving money in something like a workplace retirement plan, because a lot of folks don't realize they might think, oh, it's cheaper for me to do that. You have limited investment choices, and that's more that cookie cutter approach. You can't really adjust the money that's left in those workplace retirement plans for your current stage and your risk tolerance because there's just limited options.
One of the greatest risks that people come to learn about, and they know this as they go through the process, is if you have a publicly traded stock in your workplace plan, you're going to have a blackout period every quarter whenever they announce earnings, where you can't change anything. And they go, oh my gosh, that's exactly when I needed to make a change, but I've limited myself now. That makes no sense whatsoever.
Right. Well, we only have a minute left in today's conversation. What do you want to leave our viewers with as we wrap up everything we've been talking today about regarding market volatility and their specific retirement date?
That I believe the most important thing is if you have a plan in place where you understand you're going to have the ability to generate X number of dollars to meet your needs, it can help minimize the stress, the anxiety, the whatever that market volatility conversation has. Folks, the worst thing that ever happened to our industry, probably the best too, but the worst is 24/7 news. The reality is they got to talk about something all the time, and we all know the negative sells. So you're going to continue to hear that conversation. And if it's something you want to move away from, let's get a solid, complete written income plan in place for you.
Wonderful. Dale, Mark, thank you so much. And thank you for watching. Again, if this is resonating with you, if you know that you need help, the team of Retire Path Wealth is here for you, but you do need to reach out. 866-724-3893 is the number to call to schedule your complimentary written income plan. We love you, Arkansas. We'll see you next time here on Arkansas Money Talk.